Good afternoon. One of the most frequent questions we get is behavioral. So what should I be thinking about? How should I be thinking about my portfolio? What actions should I take? So we're going to take a look at historical drawdowns.
So we're looking at every drawdown on the S&P 500 of 10% or worse since 1960. So you have over 20 of them. And as you go through them, some of them are quick and shallow and recover quickly. Those are more in line with what we've called a V-shaped type recovery in markets, which is something we've discussed in prior videos.
Right.
And the other ones are more of what we would call a U or an L-shaped. They're generally more severe and they take longer, and it takes longer for you to recover.
Right.
So, put all these numbers up on the page, and obviously this is an unprecedented event. We haven't had a global pandemic, but the market reaction is not unprecedented. It's not. It's unique in some ways, but in other ways it's very similar to things we've seen before. So if you look at the first chart, what we're looking at here is drawdown from the peak, and these are box and whisker charts. So the darker blue shaped box is the range of drawdowns from the peak for those V-shaped recoveries. The ones that are quick and you come back. There you're looking at things like, for example, in December 2018, that was a V-shaped when the Fed made a mistake and said we're a long way from neutral. Right. That would be a V-shaped versus the lighter boxes, those U and L shaped. Now we're talking about the tech bubble and 9/11. We're talking about the global financial crisis. Right. So you can see where we're at now. We're down 30%. That puts you right at the median drawdown for a U and L shaped market environment, market drawdown. We're right in line there. Obviously, if it were to get worse, you'd think, where could this pan out? The global financial crisis was the largest peak to trough decline we've had in the modern era. So that would be down somewhere around 57%. But you're basically to the point where, the losses are right on par with other extremely bad market environments, the average extremely bad market environment. And then, if you look under the hood, the S&P 500 is only down 30% only, but the median stock in the index is down over 50 in the US equity market. Right. So a lot of companies are already feeling like this is potentially worse or as bad as the global financial crisis. And then you start to look at, the duration of these drawdowns. This one has been, it is unique in how quick it has been, how sharp the drawdown has been. So we're only in a month we're down 30%. Right. The only recent analog to that is Black Monday 1987, where you're down 20% in a day. But if this were to be more of a U or more of an L-shaped type of a situation, which we talked about earlier, it could be a while. The drawdown could persist. We don't think that's the case. We think there's still a high probability that this is potentially a V-shaped. But you can see what you could be in for. And then talking about the duration of the recovery, the chart on the right, if this is a V-shaped recovery, this could be over in 3 months. We could recover all of these losses and come back very quickly in 3 months. You think about not only the magnitude of the declines we've had, but also the magnitude of some of the gains we've had. And it leads you to believe that you could actually recover from this very quickly. Markets are moving so fast. Last Friday, just a week ago, the market rallied almost 10% in an hour. Right. So you think, how do you make up 30% returns? Well, that helps. You get a couple days like that, and you get there pretty quick. Right. So putting all of that into perspective, what we've experienced here. Now, the thing is, if this does persist, once again, it's a long, drawn-out, emotional process to go through these types of market environments. But if you look to the recovery, once we do make a bottom, the recovery starts fast. Right. It starts very fast. You get some of your best days in the market after these types of events. And if you think of all these V-shaped and U-shaped drawdowns that we've had since 1960, 3, 6, and 12 months out, on average, you're higher. If you look at 12 months out, your average return is right around 30%, 12 months after you form a bottom. The other thing to note is the deeper the drawdown, the faster the recovery. So once again, you start to price in a worst case scenario. You say we do break technically lower. Say we go down to that 2000 technical level on the S&P, then our drawdown's on par with the global financial crisis or the tech bubble. Well, that's going to be painful, but the next 3, 6, and 12 months,
The recovery is much faster.
you're going to recover extremely fast. And you think about the types of things, in the global financial crisis, you bottomed on March 9th, 2009. The next 3 months, you were up almost 40%.
Right.
No good news happened.
It was still very bad.
From March to June 2009.
It sure was.
The
Yep.
market reacts much faster than the data.
Right.
You start to make a recovery more so when it looks like the data cannot get any worse.
Right.
So that's another thing to keep in mind.
Unemployment was still going down
Yeah.
or going up, and you had a lot of bad news
Exactly.
filtering in.
Exactly. So you have to be in the game. You have to be in the game. The recovery happens so fast after drawdowns like this.
And why do we bring that point up?
Well, so when you get down to these levels, behavioral mistakes are more likely and they're more costly. So that's so important. At this point, you think, well, it's going to be difficult to say if I get out now, I'm going to miss out on bad days. The bad days have happened. What's more likely to happen is you're going to miss out on the best days because the best days have yet to happen.
Right.
And they happen so fast. There's been a lot of talk about, well, what if we just went to cash and then when we get solid news on a vaccine or the number of cases is starting to crest, then we get back in.
It's too late.
Far too late.
Behavioral mistakes. We get that question quite a bit from clients as what should I be doing? And when the markets are down this much, this fast, certainly behavioral mistakes can impact your long-term returns. So we're going to look at the cost of those behavioral mistakes. It's not a loss until you sell, right? And we've had a lot of those conversations, and the experience would show this chart's really compelling to look at the number of times we've had 20, near 20, or greater than 20% losses in a given year. So walk us through these intra-year price decline examples.
Yeah, so you're going back to 1980. Your blue bars are your calendar year returns on the S&P 500. Your orange boxes are your largest intra-year decline. So for example, we know the S&P 500 this year is down 30% from its peak. Our orange box would be at negative 30 right now in 2020. That's how you would read that. Even if you have these huge swings intra-year, the year, first off, is not lost. It's not at all lost. So you look at 1987, the first one that's highlighted, so Black Monday. The return for the year was still positive.
Right.
You were down over 30% as your largest decline, but the return for the year was still positive. Now, the timing of those gains, we can talk about that specific example, but the point is, all is not lost. Same thing in 2001 and 2002. In all of these instances, the calendar year return is not as bad as your largest decline.
Right.
So, we could definitely finish the year better than we are now. We think that's highly likely. And say we don't. Say we only recover a fraction of our losses this year.
Right.
Well, if you look back to 2001 and 2002, look what happened in 2003.
Yeah.
And you look at 2008, that was a very tough year. Look what happened in 2009.
Right.
So the market is always looking forward. If we get into June and July and the market is still down at these levels, what that means is the spring for 2021 is getting more and more coiled. And you're going to bounce back even quicker. If history, holds true, 2021 would be an even stronger year. So once again, you have to be looking forward to how am I going to make up these losses? It's not by going to cash. It's by looking at opportunities to add to equities, making sure you're in the market.
And so talk more about that decision point of what do I do? What do I do during these drawdowns of, I don't go to cash, but what do I do?
Well, you have to have a shopping list. You can still be tactical. And we've talked about this before, that the whole idea is you just want to own less equities on the way down than you do on the way up.
Right.
So your focus when you're already down this much has to be on what are the opportunities to add to my equity exposure and to buy companies that have a margin of safety or that I'm comfortable owning 5-10 years from now, almost regardless of what happens, because they're so cheap. So that has to be your mindset. And if you are going to go to cash, it's for liquidity purposes. It's literally, I need cash.
Right.
I need cash. And
you should
clients have plenty of bonds.
You should be rebalancing as this happens, correct?
Yeah, definitely.
Yeah, so maybe talk about there's a lot of folks who think are sitting in their 401k looking at their 401k. What should they be doing right now?
Yeah, so if you started out the month of, if you were at the end of January and you had a 60-40 portfolio and you haven't rebalanced, take a look at what your portfolio allocation is now.
Right.
It could be 40-60.
Right.
Totally split. So then you think, if the market recovers and I own 20% less in equities than I intended, well, your recovery is not going to be as strong.
Right.
So you have to be looking at constantly rebalancing and making sure when this thing does spring back, I need to participate. I need to participate as much as I intended.
Right. Because your risk tolerance probably hasn't changed, but your asset allocation has changed. So you need to make sure you keep that in line with your risk tolerance. All right. So you mentioned a couple times about staying invested. You mentioned about missing the best days. Well, put that into context, what that really means in terms of returns over the long term.
Yeah, if you miss out on, so for example, over the past 20 years, you take a look at that sort of electric blue line. That's just assuming a buy and hold strategy. Certainly not optimal, but that's just plain vanilla buy and hold. You just own the S&P 500. You know, right? If you had started with $100, you'd own 100. You'd have 194 today. If you just, the green line, if you miss out on the 10 best days over that 20-year time period, you've lost money over the past 20 years. Just 10 days over the past 20 years, you've lost money. And the point is, the best days in the market typically happen right after the worst days in the market. And the worst days, you know, if these worst days are very difficult and they create behavioral mistakes,
right,
this is showing the potential cost of those behavioral mistakes. If you get out and you go to cash after we have the worst day, which odds are we probably already had the worst day this year, then you're missing out on the best day, which is likely still to come. So that type of a strategy, over the long term, just missing out on those few days can really hurt your long-term results.
That even parallels to rebalancing. So rebalancing your portfolio regularly. When you have bad days, those are days to rebalance.
Yep.